Well, holy flippity flip flop flapping smokes, everyone. Credit card defaults have just hit their highest rate since after the 2008 financial crisis. Consumers are drowning in debt from the major cost of living crisis. Rents are going up, groceries are going up, insurance is going up, property taxes, and people simply can't afford the lifestyle they're in right now. So consumers are tapped out and their pandemic savings that they had saved up before have now diminished. So everyone, I hope you had a good Christmas and holiday season, but unfortunately a lot of people would have put a lot more on their credit card balances, and we're going to continue to see credit card debt soar. So everyone, you know what time it is. Let's get straight into the news, the facts, and the data. Well, look at this, everyone. US credit card defaults jumped to highest level since 2010. Consumers are tapped out after years of high inflation and as pandemic era savers have evaporated, like I said before. But let's dive a bit deeper into this report to see what's really going on. So defaults on US credit card loans have hit their highest levels since the wake of the 2008 financial crisis, in a sign that lower income consumers' financial health is waning after years of high inflation, which is no surprise. The costs keep going up, your wages aren't going up, they may even start to go down if they keep on this high immigration path, if they do what Musk and Trump is talking about with the H-1B visas to bring in lower paid migrants, to give them lower pay, lower wages, and more hours that will compete with American workers. Well, this cost of living crisis will only get worse. Because listen to this, credit card lenders wrote off $46 billion in seriously delinquent loan balances in the first 9 months of 2024. Look at this, up 50% from the same period in a year prior, and the highest level in 14 years. So this is no small amount. Just in 9 months has been nearly 50 billion, and that's up a massive 50% from last year. We're being lied to. We're in a recession right now. It's just that the US government is they're playing with the numbers, they're playing with the figures, and they're cooking the books, and they're not telling you how bad things really are. Because again, they can make it seem like the economy is growing by ramping up immigration and by having high inflation, but on an individual basis, your standard of living is falling. So this is according to data collected by Bank Reg Data, and write-offs which occur when lenders decide it's unlikely a borrower will make good on their debts are a closely watched measure of significant loan distress. That's right, a lot of people are in significant loan distress. Now, high-income households are fine, but the bottom third of US consumers are tapped out. Their savings rate right now is zero. So that's right, that's in a very alarming trend to show that the real, average US citizen is not doing good. The sharp rise in defaults is a sign of how consumer personal finances are becoming increasingly stretched after years of high inflation, and as the Federal Reserve has left borrowing costs at elevated levels. Well, I think they're just returning to normal levels because they were far too low, and it was irresponsible. Because what did they do? They got a lot of people in a debt trap. They said, look, come and get in debt now, it's so cheap, come and get your free money. Well, now interest rates are going up around the world. They may have peaked, but they're still much higher than before, and a lot of people are left with a much higher interest bill. So banks are yet to report their fourth quarter numbers, but early signs are that more consumers are falling significantly behind on what they owe. A credit card lender after JP Morgan Chase and Citigroup recently said that as of November, its annualized credit card write-off rate, which is the percentage of its overall loans that are marked as unrecoverable, hit 6.1%, up from 5.2% a year ago. And I'll show this chart here. I'll go ahead and move myself so you can see this. We can see the big, huge spike. And the trend here, we can see the trend was rising, but then the banks put a bunch of pauses during COVID on delinquencies, and now it is absolutely skyrocketing, and I think we could surpass 2010, the crazy numbers they saw after the great 2008 financial crisis. US consumers exited pandemic era lockdowns flush with cash and ready to spend. Credit card lenders were happy to help, signing up customers who might have not qualified in the past based of income, but looked like safe debtors because their bank accounts were flush with cash. Well, that was a big mistake, and we all know the banks continue to make these huge risks with these loans, but They don't care because they'll just get bailed out by the Federal Reserve and the US taxpayer. Credit card balances soared, rising combined $270 billion in 2022 and 2023, pushing the total US consumers owed on credit cards above $1 trillion for the first time in mid-2023. So that's right, we've hit a new record, guys. Hooray, $1 trillion in credit card debt. That is insane because a lot of these credit cards have interest rates of 15 to 20%. That spending, along with the coronavirus-induced supply chain bottlenecks, led to a burst of inflation, prompting the Fed to boost borrowing costs starting in 2022. Higher balances and interest rates have left Americans who cannot pay off their credit card bills in full paying $170 billion in interest in the past 12 months ending September. So that is crazy, $170 billion just spent in interest alone. That sucked up a portion of excess cash that was in consumers' bank accounts, particularly those of low-income consumers, and as a result, more of those borrowers are struggling to pay back their credit card debt, which is no surprise at all. Now, there was hope that the Federal Reserve would slash interest rates massively in 2024, but they've now put out a new prediction saying they'll only drop rates by half a percentage point compared to what they were saying of 1% just a few months earlier. And that's because the Federal Reserve made a massive mistake by lowering interest rates too quick, and now inflation is surging again. Now, this is a sign of how bad things really are. So in a sign of how consumers are struggling, even after writing off nearly $60 billion in consumer credit card debt in the past year, another $37 billion remains in consumers' cards that is at least 1 month overdue. So we could be looking at hundreds of billions of dollars of debt defaults, and this will impact the bank's earnings. Credit card delinquency rates, which are seen as a precursor to write-offs, peaked in July according to data from Moody's, but have only fallen slightly and remain nearly a percentage point higher than they were on average in the year before the pandemic. And delinquencies are pointing to more pain ahead according to Wallets Hub. And they warned that the US President-elect Donald Trump's threat of wide-ranging tariffs which could increase inflation, interest rates would be two problematic things for consumers in 2025. We'll have to wait and see how that really impacts inflation, but this report shows that the average American is really struggling. And instead of Donald Trump saying America first, what he really needs to do is put Americans first. Because as we've seen, the US is not officially in a recession right now, but the average American on the individual basis has been struggling harder than ever. Just simply existing, having a roof over your head, 3 good meals a day, travel, a car, insurance, utilities is becoming increasingly impossible on an average salary. And they need to address this problem quick because people are getting angry, very angry. So to my followers, if you are in credit card debt, I think your 2025 resolution should be to get out of credit card debt as soon as possible because things are going to get very tough. And don't even worry about investing until you got that credit card debt paid off, because you may be paying an interest rate of 15 to 20% and a good return in the stock market, or for example on gold, silver, the average return. Yes, we've had very good returns the past year of 20% plus, but historically you may only get a return of 7 to 10%. So it's simply not worth taking the risk. Get a guaranteed return of paying off that debt and having that stress off your shoulders. But everyone, what do you think about this report? Let me know down below. Now, for all my loyal viewers and subscribers still watching, you're awesome. Thanks for watching. I'll see you all in the next video.